Good morning, everyone, or good afternoon, depending on where you are. Welcome to the February edition of the Yankee Model Investment Club. My name is Brent Gall. I'm the president. If you haven't joined us before, I'll walk through some introductory slides just to give you a flavor of what our club is about and how we do things. And then we'll jump into the agenda for our standard meeting structure. So the Yankee Model Investment Club, it's a better investing model club, which means we're fully functional with real money, but we are observation to the public with the intent that people that are new to investment club membership can join us and see how an investment club functions, ask questions about the formats or the structure of the meetings, and hopefully be motivated to create your own investment clubs with your friends and family so that you can have the same sort of experience in a smaller setting. But we are also open to new members in this club. We were formed back in 2008. We're currently 6 members spread across 4 different states. We meet purely online since 2011. And we meet the second Saturday at 11 a.m. Eastern every month. Like I mentioned, we are looking for new members. We don't require any previous investment experience. We provide a mentorship program with using an existing member, and really no limitation on where you live except where state tax laws require our club to file a tax return. To be a partner or a member of the club, you must be a member of Better Investing. You're expected to actively participate in club activities. This isn't a passive investment vehicle. And you make stock presentations using the stock selection guide in rotation with other members, in addition to, on a rotating basis, presenting a short educational segment that I'll cover a little bit later. For operations, we follow better investing principles. We show respect to fellow club members. None of us are perfect or experts in this field, so we're all still learning. We keep that in mind. We perform an annual audit, we file tax returns, and we follow our partnership agreement. If you have any questions that aren't answered during the rest of the meeting, or if you're interested in joining, feel free to reach out to our secretary, Shriram, at the email address shown there. I'll put his email back up on the screen at the end of the meeting in case anything comes up during the course of the discussion. For the structure of the meeting, we follow a standard agenda. A copy should be in the handout section of the control panel of GoToWebinar or GoToMeeting. I'll also put it up on the screen here shortly. All visitors will be muted, but you can type in a question using the control panel, the question section. And our moderator will try to answer those as best as possible and can also read them out to the larger audience in case it's a general topic that would be of interest to other people. Regarding registering, just a note, if you were forwarded this meeting invite from someone that you know, we really encourage you to register at Better Investing just so that you are included in any mailings on changes to the time or date of future meetings, as well as automatically get the individual invites to the meetings to log in. So you can just go to the Better Investing homepage and search for online events and click the register button if you haven't already done so. And I think that logs you into the next scheduled meetings, which I think we generally do 4 months or 6 months out. And then finally, a disclaimer, we will be discussing financial topics and securities in this meeting. In no way should you take that as investment advice. We are not investment or financial advisors or financial planners. So do your own due diligence, do your own research before you invest your money and make your own decisions. And with that, we'll jump to the standard agenda for today. Our next segment will jump to the educational part. Liz will be going over preferred procedure. I'll make you presenter.
Thank you. Good morning, everybody.
Good morning.
Okay, so can you see that? Show my screen. Here we go. See that?
Yep.
Great. Okay, so this is the preferred procedure, and I chose this because I didn't really know much about it. This is the source that I used, which was a 2019 video that Ann Cunez did. I did a search in the video learning library for preferred procedure. This came up, and there was a few other articles, another video that came up. And just this week, Ann did another video on the preferred procedure. So if you go to the learning library, you can see the whole video, and it's quite comprehensive. What I'm going to offer you is a much condensed version. One thing that Ann did say was that she would recommend that if you haven't already done a few SSGs, that the preferred procedure is a little bit more intermediate. So she suggests that you do some SSGs before you start to incorporate the preferred procedure. So the preferred procedure, basically, you use it to refine your earnings per share growth projections. So just to recap, you use the earnings per share growth projections to calculate your projected high price for the stock that you're studying. And you want to project your EPS growth 5 years into the future. And the better you can estimate the 5-year growth projection for the EPS, the better you can project your estimated high price. And this means that your SSG's buy, hold, sell range is going to be more realistic too. So basically, the preferred procedure is a way to estimate your high EPS to get you to the high price, which is your bottom line to get you, are we in the buy, hold, or sell range for the stock. So there's some better investing guidelines for estimating EPS growth. So you want to make sure that your estimated EPS growth rate is no higher than your sales estimate, because one of the better investing tenets, and I guess for stock investing generally, is that price follows earnings. So so you want to make sure that you're not projecting your earnings more than your price. No, I'm sorry. Earnings follow sales. That's what I mean to say. Yeah. So your EPS growth rate no higher than your sales estimate. And so it's difficult or unlikely that a company is going to be able to sustain a growth rate of 15 to 20% over the long term. So it's a good general idea when you're doing your research to cap your estimated EPS at, say, no higher than 20%, but that's a guideline, and there might be exceptions to that rule. So one of the things that you want to think about while you're doing your research on a company is, can you answer this question? How is this company going to make money? How's it going to make its earnings grow? And using the preferred procedure can help you to answer this question more fully. So let me go to my next slide here. So you want to make sure that you're doing your research, and the preferred procedure really requires that you delve into the research. So you're going to look at the company's income statement, and the income statement will take you on a journey starting at the company's top line, which is sales, and it'll take you all the way through their expenses, the taxes, all the way down to their bottom line, which is the earnings per share. And if you think of it this way, so a company's income statement gives you a look into that company's past performance, whether it's the last quarter or the last year. And the preferred procedure helps you to project the company's future performance 5 years into the future so that you can say, you know, is this a company that is likely going to give me the return that I'm looking for? The main benefit of using the preferred procedure. So you think of the preferred procedure as a simplified version of a company's income statement that allows you to project the company's future performance 5 years into the future by calculating future earnings based on revenue growth projections. And this connects your future sales to your future earnings per share. So the elements of the preferred procedure. So in order to reasonably project your high earnings per share 5 years into the future, you need to make reasonable 5-year projections for revenue, pre-tax profit margin, the tax rate, the preferred dividend, and the number of shares outstanding. And here's a simplified example. So say these are your historical averages here. These are your 5-year projections based on the research that you did. So going through all this, you come to an earnings per share of $1.30. And so these are your projections. So what you're looking at, what is my projected earnings per share 5 years into the future? So here's the formula, and the SSG will do the math for you. So you're going to take your revenue minus your expenses equals the pre-tax profit minus your taxes, your preferred dividend equals your net income. You divide that by the number of shares and you get your earnings per share. So when you're in your SSG, you're going to open up the SSG Plus. You're going to go to historical earnings and click on this box here, and it'll open up a pop-up. And here's the pop-up. And so it gives you some default judgments here, and you can put your own numbers in here. And that is the beauty of the preferred procedure, is that based on your research, you are going to want to put your own judgments in here. So where do the default judgments come from on the pop-up? So the stock selection guide is going to automatically populate the default judgments for you. And so the projected 5-year sales growth rate is the number that you entered in on the first page of the SSG. So you want to make sure that it's your best reasonable judgment backed up by your research. And then the SSG is just going to calculate the 5-year average percent of pre-tax profit margin for you, automatically populate that field. It's going to put the tax rate in from last year, and it's going to pull the preferred dividend from the current preferred dividend information. And then, so once you put your numbers, your judgments in, then you just click update, make sure you save it. So why go through these extra steps? Well, sales growth is often more predictable and regular than earnings growth. So it's beneficial to use the preferred procedure to get an accurate projection of your earnings per share. And it's also a way to get a second opinion on whether your initial analysis of the EPS growth projection is reasonable. And I'll talk a little bit more about that. So basically, there are 5 elements of the preferred procedure, but you can kind of boil it down to these 3 elements: the sales growth, the percentage of pre-tax profit margin, and the number of shares outstanding, because the tax rate doesn't change that much and it's out of the company's control. So it kind of is what it is. And most companies don't have preferred stock, so usually it's a non-issue. It's just going to be 0 that you're going to put into that field. So you don't really have to do much extra work on that. Okay. So you can change all of the default judgments, and changing any of those default judgments is going to change your bottom line, which is your 5-year EPS growth estimate. And so remember, changing any of those default judgments is going to change your projected high price, which is what we're ultimately looking for, which is going to change your buy, hold, sell range, most likely on the SSG. So you can play with the numbers. So here, the default judgments here. So what happens if we put 20 here? So if I think that, okay, I'm going to come up with an EPS of 16.4, what's it going to take for this company to sustain that? Well, maybe I know something about the tax rate's going to change. So maybe if I lower the tax rate, or if I know that they're going to be over the next 5 years issuing more stock, if I change the stock outstanding, just changing these two numbers will bring me down to 12.3% instead of 16.4. So this is what I mean about you can get a second opinion. You can play with these numbers and kind of back yourself into, okay, if I think my EPS is going to be this, then I know that, okay, they're going to have to do their sales at 14% consistently. What happens if they don't? Change that number, you're going to get a different number here. So, so basically the preferred procedure helps you to deepen your understanding about the company. So it makes you think about how a company makes money and how it's going to grow. And it helps you to better understand the company's business model, because when you're going through the preferred procedure, you're going to have to look at, okay, so how are they managing their business? What are their expenses? How profitable are they? And it can increase your confidence in your earnings projections by basing your earnings growth projections on your own research and analysis, and by applying your own logic to what you have found out about the company's business. And it reduces your reliance on the analysts. So that's it. Anybody got any questions?
No questions are posted.
All right, thanks, Liz. Go ahead, Jack.
I thought that the example that Anne used this past Wednesday, I guess, was Microsoft, and Microsoft's pre-tax profit was going up, and I think she said it was because of the services, primarily led by the cloud computing with the Azure platforms that Microsoft has, was growing faster than the rest of its company, than the products they sell, the other products. So the pre-tax profit was going up because of that. So I think that was, for that example, it showed very well how they're growing and why that increased the pre-tax profit rate.
Mm-hmm. Yeah, and it makes you look into, say, what are they doing that's different? How are they going to sustain this? Right. Yeah. Thanks for that example.
One feature that's nice on the desktop app toolkit that I use, I'm not familiar with the online SSG to know if it has the same thing, but you can click on each of those entries in the preferred procedure, and it shows you kind of the last 10-year trend.
Oh, right.
Do you know, or does anyone know whether that's a function?
Yeah, that is, and I forgot to put that in here. And that is why, and hour-long, here they are here. That's why Ann did an hour-long presentation, because you click on each of these, it gives you the historic, and Ann goes into more about like how to research each of these. There's a lot more to this than what I've outlined today. Each one of these tabs here opens up and could be an hour-long presentation in itself.
Okay, yeah, so that's why you touched on it, and it's a important point that really, if all the numbers stay the same, if your judgments are exactly the same as the defaults, there's not going to be much change to the earnings or the preferred procedure results. But if you click through those different, I guess, categories, and like Liz and Jack were mentioning, that you see pre-tax profit margin historically maybe is on the decrease, you may decide to judge down that percentage to shore up your analysis a little bit, versus thinking that if, like, over the last 5 years they've consistently decreased their profit margin, it's not really, it doesn't follow very well that they will miraculously turn that ship around and have a much higher profit margin just for the sake of your preferred procedure. So it is always wise to click through those just to kind of see what the historical trends have been like and whether that can influence your assumptions that you make. But overall, great presentation. Thank you for this. I don't know that we've gone over preferred procedure as a educational segment in our club history before, so this is a great introduction. And yeah, tons more to learn on this, and you can kind of go down the rabbit hole for judgments to use and things like that. So thank you, Liz.
Okay, you're welcome.
Okay, moving on with our agenda. Let's give presentation rights to Sriram for our minutes from last meeting.
Can you folks see my screen?
Yes, sir.
Awesome. Thanks again. Here are the minutes from last month's meeting. We had about 52 visitors in all, and one prospective member was there, Ms. Watkins. Apparently, she will not be able to join us for a couple more months. Hopefully, she will join. We had an educational segment on return on equity. And then Jack presented minutes from last month. Here's a snapshot of our holdings as of the meeting date last month. And this is the distribution of our holdings in different market sectors, mainly by the size of the company. And we had a stock SSG presentation by Jack on EBS, and we decided to buy DHI, and I believe we sold Athene. I think that's it. On the old business, I did present the final version of the when to sell stocks, and we finalized it and posted in the public page. And then after the meeting, we had the audit process. Here are some of the questions that Joe captured, and we answered those questions. And after a lengthy discussion, we adjourned at 13:39 Eastern Standard Time. So it was a long meeting, but it was a good meeting. Any questions or comments on the minutes?
Okay, thank you, Sriram.
Yes.
Jack, will move to you for treasurer's report.
Okay. Can you see my screen?
Yes.
So we usually just look month to month at what our performance is, but I wanted to look back over the past year. So what I'm showing on the screen is a chart that shows the value of our total holdings from January 2020 to the present. Actually, to Thursday. I didn't count yesterday's. So shows the dip, the COVID dip in the stock market that affected us, but a relatively steady rise after that. Overall, from the low here in February 2020 to the present, we went up 22% versus 20% for the Vanguard 500. If we go all the way back to January, it's not much different. It's 22%, 22.1% instead of 0.4% since January versus 19.5% for the Vanguard 500. So the numbers, this looks like a steeper rise than these numbers indicate because we invested $14,000 over the course of this 14-month period, which makes sense. We invest about $1,000, a little more a month these days, a little less before our new members showed up. So this is from Bivio, which does these fairly complicated calculations for us to show us how much we're really making. So 22% rise would be great for us if we could keep it up forever. Let's hope. Okay, so I'll go to Bivio and show you what I usually show every month. The valuation, first the valuation for our club as of Friday. It's
Are you sharing the
100.
Vivio screen?
Oh, am I? Oh, geez. Did you see the chart?
It went,
The-
yes, we saw
We
the
can see the
chart,
Excel.
but it went black
You still
again.
see- Okay. All right.
Liz, I sent you a private chat if you would check it. Thank you, Liz.
You're welcome.
All right, we can see the chart again.
Okay. I don't know why this is doing this.
Jack, if you
It's
want me
gone
to
now.
jump in with Vivio, I can do that.
Yeah, could you please? I don't know what it's doing.
Okay, you got my screen now?
Yes.
Yep.
All right. So just
Um,
tell me which screens you want to see.
Okay, so the total value is a little below 200,000 as of Friday, 197,000. And the distribution of the shares, so Dollar General is our largest holding at 10% of that 197,000. The lowest is Miller and Sprouts Farmers Market, which is about 4 point something percent.
Actually,
Um,
Alpha is the largest holding.
What, oh, yeah, I'm sorry, I keep doing that. 12, that's, Alphabet is 12.8%. Dollar General is 10%. Okay, let's see the, I think member contributions is next. Member status. Okay, looks like we're all paid up. The next one is transactions. We got a little interest and do we get dividends? It shows we bought some DR Horton in two bunches, 183 shares, and then a fractional set of shares, which was an accident, but it's nice to know that we can do that if we want. We sold 340 shares of Athene, got $14,500 or so. And then after the 30 days had passed, plus a few days, we rebought shares of Essent for just about the same price we bought the Essent originally. Okay, we did get a couple of dividends worth $70 from Gentex and Dollar General, and all the member contributions are there.
Jack, is it worth mentioning or telling the audience anything to look out for if they don't want to buy fractional shares? Like how do you put the order in to avoid that?
Yeah, what Fidelity lets you do is to put in a dollar amount or the number of shares. And I've been using that tool to just calculate for me the number of shares I should buy for a given dollar amount. But this time it just bought that, whatever the amount was, $12,000 something. It bought $12,000 worth of shares out to the third decimal point. So if you want to buy something like Alphabet and you don't happen to have $2,000 or whatever the value is, you can say, I want to buy $500 of Alphabet, and it'll give you whatever it is, a quarter of a share. So that's nice, but you should just know that that's what it will do.
Okay, so just be sure that you put in the whole number of shares that you want as opposed to here's the money that I want to spend and make the share count match.
Yeah,
okay.
Exactly. Okay, so for the life of the club, that back to, oh no, this is for
That's the life.
from last year. We're at 14.5% versus 14.5% for the Vanguard 500. I guess that was yesterday's that did all that. We went down several thousand, $3,000 yesterday. The club did to just below. And this is no, this is for a year. What was the other one?
The other was life.
Okay.
From
So for the
2008.
year, we're still a little behind Vanguard 500. So I'm uncertain why. So I think it's just the yesterday it went from, I think we were 22 point something and now it's 21.1. So my chart isn't wrong. It's just that yesterday was a bummer of a day. Investment performance. So Miller's doing great. It's up 90%. Who else is doing well? Middleby's doing fine. Tractor Supply, Intelligent Systems. Yeah, everything's doing well, including even Ulta's doing well. Essent is down 7% since we bought it last month, which is kind of that's the way things work around here.
Yeah.
Sprouts is doing fine too, and the DR Horton are both up, but we've only held them a month or two, so it doesn't bother doing the calculation. So the next is the investment or the member performance. And I'm doing great. I don't know about you guys, but most everybody's doing about what the club has been doing, 14%, which is fine. We're doing good. Sri Ram and Liz have been in the club not long enough to make the calculation reasonable. If you click on the detail, you can get the numbers, the raw numbers. Okay.
Oh, 43%. Nice work.
Yeah. Well done, Sri Ram.
Yeah.
I think Liz has done similarly well. Okay, so I think that's it. Yeah, let's look at capital gains and losses for the year. We have to change to 2020.
Mhm.
So this is what we're going to be working on, trying to deal with the realized gains, which are, we lost $500 short term on Middleby, oddly, and we gained $4,500 on all these other things. You can see that we did harvest $1,500 worth of losses from Essent, and we gained on everything else. So overall, we gained about $4,000 last year, which we'll have to divvy up in K1s and among the members. Okay, that's the treasurer's report.
Okay. Thank you, Jack and Ira, for that. If there's no other questions, I'll take presenter rights back to go over our stock to study. Okay, you can see my the analysis template here.
Yep.
Okay. So this month we'll be going over a company called First Savings Financial Group. It's actually a holding company for a First Savings bank that's based in Indiana. It's traded on NASDAQ. What was attractive to this is it's a small cap, which we've struggled to find in the past. And so even though, in my opinion, the banking industry is not the most exciting to review, I figured that this was a good candidate for the small cap feature just to even out our portfolio. I just wanted to touch on where I found this. Ira sends a biweekly Better Investing High Growth and Value company screen. And actually, I forgot to ask Ira where you get that. I don't think you generate it. Are you on a mailing list from Better Investing?
That's right. It's an email.
An email, okay. So it's every other week they've put together the high growth list of companies that meet certain criteria, and I can actually show the copy that I went through here, and really just started at the beginning and went down the list, pulling up each in the SSG and using really just section 1, the visual analysis, to kind of sift through and filter out companies that didn't really look great. So this was very helpful. And I referred to this after I used an online screener as this had better criteria than the online screener that I used, because I was looking at companies with at least, I don't know, 15% or 20% revenue and earnings per share growth. What I was finding, though, on the screener was that they were such horrible companies that, like, the earnings per share was negative. So I guess the projections were, the only place it can go is up, sort of thing. So after kind of spending some time on the online screener and getting disgusted with it, I turned to this more reliable company screen list and was able to pare down to this company. And this was actually one of a handful of banking. This one isn't perfect, but it had some advantages, I think a good price point, as well as some other historical good trends that made this the more attractive choice, in my opinion. But anyway, it's in industry, is the banking, obviously. It provides banking services to individuals through 15 offices in Indiana communities. It accepts deposits, checking accounts, withdrawal accounts. It looks like, though, that the main business is different types of loans focused on like mortgage loans and real estate, and conducts lending and deposit activities with small businesses and individuals. We talked about where I found its location, as I mentioned, 15 offices in Indiana. So it is, very regional. It's not a countrywide or international entity, but I wouldn't really expect that for such a small cap company. Regarding the kind of the financials, I excerpted some information from their financial insights page on their website, just showing their overall assets, loans, deposits over the last several years and year to date. Did some additional math on just some tricks as far as where they get most of their money from. From what I understand, one metric is deposits over total liabilities, which they're around 60 to 80%. I think these numbers indicate that it's more of a loan bank versus an investment bank. Then looking at loans over total assets, that percentage rate, loan over deposits, this seemed to be at the higher end, but I don't know that this is out of family for other banks. One metric that I did see was looking at the amount of charge-offs, or I think it's basically how much of their, I guess, portfolio or holdings, I'm not sure the best term, is basically bad debt that they have to kind of write off their books. Which this low percentage, it's, from what I understand, is good to know that it's not a huge chunk of their overall holdings, that the bad debt that they, or the bad loans that they've loaned out are not a large portion of their overall portfolio. And then these are some more excerpts from their 10K, just showing the allowance for those loan losses or the charge-offs, like I mentioned, as well as compared to the net charge-offs. So they have a little bit of cushion between what they allocate for those bad loans versus what they actually experience. And kind of just restating, in more terms, just the allowance for the loan losses over the last couple of years, total charge-offs, and how they've gone through that. So I think they're making a healthy provision for bad debt or charge-offs, but they haven't actually really seen that as far as this reveals. Okay, moving on then. So growth company, I deem it a growth company. I'll jump to the SSG a little bit later, but in the last couple of years, they've had great revenue growth, around 20% over the last 10 years, and 43% average revenue growth over the last 5. Looking at a couple of analysis companies, they really don't do a deep dive analysis into this. Morningstar has it as a fair value of 63.74, which it ranks as about a 3-star rating currently. They selling at I think when I last checked earlier in the week, it was like a 5% discount to the fair value, which was promising. Value Line, it doesn't do really their projections or analysis. It just gives their performance ratings, different characteristic ratings: performance of 2, safety of 4, and technical of 2. And then CFRA, that was one source where they did a little bit of analysis and projections. It was a strong buy at 5 stars for them. I couldn't really see a 12-month target that they had. But reasons for the strong buy was the growth potential of earnings per share and cash flow. Current valuation, which is price to earnings and price to cash flow, are the main drivers. And overall, they scored this company in the 5th percentile of their model universe, which is at the higher end of that. So then looking at projected SSG growth, like I mentioned, it was between 20 and 43 historical for the last 5-10 years. I judged it down to 13%, just as kind of a round number to use, and set the earnings per share projection to be the same. And I did this kind of blind to the preferred procedure, but when Liz was presenting today, I went and quickly checked, and really the preferred procedure comes out to be like 12.5%, so right around 13% as well. So I left that as is for the analysis. We'll see in a little bit that there's a little bit of padding on this, so I could even judge this down further, I think, and it would still be a attractive company price-wise. Pre-tax profit margin around 25%, which has been even for the last couple of years. Earnings on equity or ROE 14.9%, which is in the uptrend. For PE history, it's been averaging around, in the high teen or mid-teens, low 6 to 11 for the last several years. Down pretty low last year, but I think that's because their earnings per share growth grew so much, and without a big jump in the share price. So that was kind of, that ratio was diluted a little bit down to the 4 to 2 range. High price next 5 years based on this, $300. Low price next 5 years, recent severe low price $29. So I actually had a buy up to 97. It's currently in the 60s, I think 61 or so. Upside downside ratio 7.4 to 1. Relative value 38%, and then compound annual growth rate of 38% or projected of 33%. So I'll just go over some of the good and bad, and then we can jump to the SSG. The highlights are it's small cap. Like I mentioned, we've kind of struggled finding smaller companies to add to the portfolio. Very strong historical sales and earnings growth, which is promising. A positive ROE and above 10% ROE since 2017, and strong return potential even with the diluted growth rates. And what I mean by that is just the judging down the historical sales growth significantly, it still looks pretty promising. Some of the bad items: no moat. Value Line did have it as a C+ financial health, which on the face of it sound pretty concerning, but I looked at other like small cap banking or financial companies, and they were really at the B-. So I guess a little bit better in their judgment, but not orders of magnitude better. And I couldn't find much information as far as what the nuts and bolts of Value Line's financial health judgment is. They just say it's based on a couple of different metrics, but they don't actually give the formulas or anything, or at least that I could find, to say what actually drives that financial health judgment. And efficiency ratio is a little high, around 70%. And this translates, from my understanding, to basically how well they're able to turn their income into profit. So the lower the number here, the better, which means that for this, they like approximately 70% of their, I think, of their take-in is spent on like overhead and other expenses. And one thing, I'll beat Steve to the punch, but I believe, I didn't write it here, I think there was one toe snub in a couple of years ago from an earnings per share standpoint. It might have been actually earlier this year in 2020, but I think that had to do severely with the COVID and fallout from that. Okay, let's jump then to the SSG. So this is the visual analysis. So once I initially saw this, I thought this was a great company to look at. I just for historical purposes, I took out the last back like over 10 years ago, But since 2015, 2016, their revenue growth and even earnings per share and pre-tax profit have been growing, great. So like I said, even though there's been a high historical growth rate, I judged down the growth values to 13% for both. We talked about section 2, these metrics, that pre-tax profit was, even, return on equity was up. This is what I just wanted to highlight. The high price 2019 to 2020 really didn't change a whole lot. Their earnings per share, though, grew significantly. So I think that's why we're seeing such a low, high and low PE for 2020. But I took the average of this section just as kind of a nice middle point to proceed with the analysis. Left the other defaults as is, and like I mentioned, got it into the buy range of under $97. It's currently, $61.60 is the current price. And then that yields us within 30% or so for the projected growth rates. So overall, I think it's a promising company, small time, so it's not going to have wide-reaching effects. It's a small, Indiana company, but seems to be at a good price point with good growth potential. And I think there's a lot of room to grow in this, even if we judge down that, growth rate is going to be 10% or lower. I think at this price point, it's has a bit of potential. So it looked promising. And that's it for me. Any questions or feedback?
Were you able to find out about their loans, whether it's like in residential real estate or is it in commercial?
I think I saw it mentioned somewhere that they're like really into mortgage loans. I didn't look any further past that, so I think a lot of it is residential, but they do have a mix. But I couldn't tell you what percentage is residential individual ones versus commercial or larger ones, unfortunately.
Okay, thanks.
I looked at that, and they had a big slug of PPP loans over the last year, so that ended up being a big part of the increase in loans in 2020 that they had.
Okay.
So those are commercial loans, I guess.
Right. Okay.
I ended up getting very similar numbers to you, Brent. I think my buy price was 97, I think. Let me find it. Yeah, 97. What was yours again?
Yeah, mine was up to 97.20.
Yeah. So my analysis ended up being almost exactly like yours.
Okay. One thing that I didn't mention, I hesitated to do a financial stock because I feared that we were kind of overexposed to it. We did sell Athene last month though. So I think we currently have Visa and what are the other ones that are like financial related?
FleetCor system.
FleetCor
is
Yeah.
Yeah.
Okay. So it's in the financial realm. It's a small regional bank, so it doesn't compete on the same level as those guys, though.
Yeah.
There was a surprising amount of like banks and financial companies on that screen list, and I don't know if that's just because that sector has been doing great over the past year, or if it's I haven't been familiar enough with that list to know if that's the usual trend, or if it's just something that's recently happened. But there were quite a few financial companies on there to sift through.
Joe may have some thoughts about that, but I think it's because people were worried about everybody going bankrupt with COVID. And some people did, but apparently not enough to, or the various programs help people from defaulting on their mortgages like crazy.
As we saw recently with the current filings that have been showing up from various banks and other companies also, banks appear to be holding up quite well, especially here in the fourth quarter and for the year, as far as their profitability is concerned. So most of them are off a little bit, but nothing really that I've looked at.
Yeah.
Nothing real serious. In fact, some of them have looked very strong.
Yeah.
Okay. Anyone else have any comments or questions?
Yeah, I like the return on the assets. If you look at that, that was very strong. Also, I have it in the buy range with somewhat similar numbers to yours. I think in general, I think it's a pretty good time to buy bank stocks. The yield curve is going up. That wasn't mentioned before here. And that's always favorable to banks as well. And it's a small company, so looks promising.
Okay, thank you.
It has a PE ratio of 3.6, is that right?
Yeah, 3.7 or so. Yeah.
Yeah. That's
yeah, I know. I think I'm doing the things right. So, I'm not sure where if the other shoe will drop sometime, but all the metrics look very promising.
Yeah, the return on average assets, 2.23%. Anything above 1.5 is really excellent. Is that right, Joe?
Yes, sir.
Yeah.
Hi, this is Sriram. I have similar numbers. My low is a little lower and higher is a little higher than you folks. But on the whole, I think a couple of things. The market, the industry itself is good. Number one. Number two is it's a small business and something we can hopefully see growing at a larger rate than other companies. So I'm okay. I like it.
Okay,
I don't
thank
know
you.
if you mentioned, and I didn't notice what the daily sales volume of stock is, number of shares.
I didn't mention, and I didn't really even think to look into that. Is that just a metric on how popular it is?
Well,
I guess
how liquid it is.
how liquid. Okay.
How liquid this, if you needed to get rid of what you own, are you going to cause a movement in the market with the number of shares you have? Probably not with us, but if somebody was busy trying to get rid of stuff, if they try to sell too much off, they can have a significant effect on the price of the stock if it has low daily volume.
Gotcha. Okay.
Yeah, the daily volume is 5,000 shares. That's it.
It's not a huge market for pieces of the Indiana banking industry.
But just as long as everybody on this call doesn't go out and buy it, I think we'll be okay.
Right. Okay, Steve, any parting thoughts before we move on?
But of course.
Okay.
So this thing's Altman's G is 0.35, and I know it's a bank, but I still don't like the number, so I'm complaining about it. This thing's market cap is $144 million. So at first I thought, oh my God, that's a nano cap, but no, I was wrong. This is actually a micro cap. So the definition of micro cap is $50 to $300 million. So I guess this is causing me to get nervous because it's so small. So is this thing going anywhere? Probably not. And I feel a lot better about it hearing the analysis today. But do I really want to invest in a bank with only 15 branches and one central or main branch in South Indiana that borders Kentucky? I guess Louisville is their big market. That's where they are. So I had some conflict with that. One of the reasons that I do like them is they interest rates are extremely low, as Ira alluded to, and it's nowhere to go but up. And they had a blowout quarter, almost a 200% increase, right? So that was quite kind of nice. But to Jack's point, last year you see big growth, but it was because of the stimulus. And guess what? They do small business administration distribution, so they must have been the go-to bank for that, and they must be very efficient, and they made a fortune doing that last year. Well, that's not going to stay around for forever. Maybe another year, I don't know. Of course, this is the package they're bandying it about. So I really tried to cut this thing down at the knees. I was not pleased with it, and yet it's still in the buy range. So I chopped this thing down to 10% sales and 10% future growth, and the buy price was still $90, and we're way under that. So I mean, everything I did to this, I couldn't get it to not, come out. So that's kind of where it is. And I also was reading the 10K, and I didn't see anything in there that bothered me. To be honest, I skimmed it, except that they haven't had a federal audit in 5 years, and then, or a government audit, some kind of an audit. They were saying they hadn't had it in 5 years. And then the other thing that I liked that I read was they generally don't give out loans without 20% down. So, and they seem to be conservative, which I liked. The other point that seemed to be driven home here is I went to the website, and you see the CEO, and he seems to be, I mean, if we lose that guy, I think you have a problem. Obviously, he's probably one of those people that built this thing. So if something happened to him, I'd be very nervous with the stock. But with him at the helm, I think it's slow and steady wins the race. I don't, I just, other than this stimulus package coming out, I just don't see a huge catalyst for them with 15 branches and one central office. I don't know. And they're tiny. That doesn't mean that they're going away. And again, I chopped them down to 10%, and still the buy is, my buy range is $29 to $90. So I'm ambivalent about this. I guess I would put it on a short leash. And we could try it, I guess.
Stephen, I heard you say one thing. I'm a former bank examiner, among other things. And what you saw probably was that the SEC has not visited the holding company in 5 years. I can promise you every 18 months, since this is a savings bank, the Office of the Comptroller of the Currency is in there sometime in every 18-month period. that is pretty standard in the industry. And I used to work for the controller of the currency.
That sounds
Somebody
good.
looking
Thank you.
at it.
Yeah, that's good.
Okay, thanks for the comment, Stephen. I had similar concerns on, it kind of takes a paradigm change in my mind, at least, to we deal with these multinational companies, and then to shift gears to a local bank. But I kind of tempered that with, what can you expect from I thought it was small cap. You're saying that it's micro cap. So
Micro.
yeah, I wouldn't put a whole lot of, my expectations are not huge for that, that you kind of get what you're investing in. And but point well taken as far as this probably won't go off like gangbusters or anything, but it seemed to me that it's a fairly strong company with some growth potential. Okay, well, thank you everyone for the feedback. I think that was a good discussion. Let's proceed with looking at our current holdings. Ira, can I give presenter rights back to you, and as we're going through, we can pull up the Bivio holding list?
Sure.
Okay. Okay, so I will start off. FleetCor posted fourth quarter results, earnings over the past year, as expected. Earnings and revenue took a hit based on coronavirus effects. Their earnings per share this past year fell 5%, but they beat the estimates, so that was positive, as in they fell less than what was expected. Similarly, revenue declined 11% over the past year, but again, those beat the estimates as well, so that was promising. Outlook for 2021 is tempered, but they're looking at organic revenue growth to be in the 9 to 13% range. They also announced that it had acquired a company called Roger, which is a global accounts payable cloud software platform for small businesses. So the hope is that this helps get them even more exposure to the small business world, and make those payments options even more seamless with their other products. So I currently have FleetCor in a hold range. The buy is up to $233. Current price is $264. And then Tractor Supply, fantastic year for them. Their year-end results, net sales increased 27%. Dividend increased 30% to 52 cents per share, they announced recently. All geographic regions of the company had robust comparable store sales growth. They mentioned, I think, in the year-end financial call that stock buybacks is still a possibility based on their robust cash on hand and other liquidity characteristics. They're tempering their expectations for 2021 just because of the ongoing unknown effects of coronavirus, effects of the vaccine, how those things are rolling out. But still, I think they still have, there's still strong potential there. They did mention that they'll provide one-time payment, $50, and allow time off as needed for all hourly team members who elect to receive the COVID-19 vaccine. And they're even coordinating to have on-site vaccinations for their crew. Didn't see that they were opening it up to the public, but at least they have a plan roll out to vaccinate their staff, which I thought was a little bit promising. It's well beyond our buy range. Our buy is up to $66 or so. It's currently $159, so I have it well in the hold range. That's it for me. Steve?
Yeah, so we've got DR Horton Incorporated Its Altman Z is a very nice 5.9. Market cap is $29.9 billion. And we had a wonderful quarter. We reported 5.9 billion, and they blew out the estimates of 5.6 billion. In researching this month, the housing starts and new permits are currently at the highest level since 2006. And of course, this is very good news for D.R. Horton. I've got DHI in the buy range. My buy range for them is up to $101.50, and the current value is currently $82.18. So plenty of room there, surprisingly, and it looks, I have to admit, it looks strong. Visa, its Altman Z is 7.02. Market cap is 462.9 billion. It reported 5.7 billion for the quarter instead of 5. So it beat the estimates. The estimates were 5.5. We're at a 52-week high practically. The 52-week high was $220, and we're at 209. And the 52-week low was 133. We did get a smidge of bad news, well, more than a smidge. They were going to strangle the whole payment market by buying Plaid. Now, of course, Plaid is the underneath of Venmo. So if I want to trade money or give some money to people at work, we all have Venmo on our phones and we can swap the money around if we go to lunch or something. So DOJ said no. So that's the end of that merger. Although Visa does have a stake in Plaid. There was a little bit of good news. MoneyGram in Europe. So I didn't get exactly, but you can MoneyGram money to your Visa debit card now in Europe. So more of a hook in. It was a big thing. So Europeans get to have this extra feature for their card. I have Visa in the sell range, but I'm thinking that the vaccine is starting to roll out. We're going to have a super strong summer. People want to get out and spend. We need to hold Visa. This thing is going to skyrocket towards the later part of this year. That'd be my analysis there. Alphabet, Altman Z is 10.99. This is the fortress stock of all fortress stocks. Market cap is only $1.4 trillion. February 2 earnings report of $56.9 billion versus a forecast of 53.1 was a blowout. People are starting to advertise again. I'm going to take a tangent here because Ira last month asked me how would Alphabet be restructured if it was broken? And quite frankly, I got very scared. And I got scared because the best website that had the breakdown the best, believe it or not, was Elizabeth Warren's, which freaked me out. So, and she delineates how it's to be chopped up. So obviously there's two giant platforms, search and the ad exchange, they call it. So I'm guessing that the ad exchange is things like restaurant ratings and hotel ratings and this, because what does everybody do? Everybody goes to Google Maps. Well, that's killing Yelp and it's killing TripAdvisor. Oops, more reason for me to keep Google. Then they'd also chop out all the mergers that they would do, like Waze. Well, they bought Waze, they bought Nest, they bought DoubleClick. All that they would become independent entities. I'm not sure where Google Classroom falls into, but that's huge. And you've got Google Verily Life Sciences. That'd be another thing that get chopped out. You've got Waymo, the self-driving car. You've got Android OS. And of course, you've got the cloud web hosting. So I've got it from my 2-hour analysis chopped into 10 buckets. And I think we'd make a fortune if so this to me is a hold. We do not get rid of it. And shockingly enough, when I did the SSG for this, Google is in the hold zone, but just barely. My buy price is up to $2,045.50, but it's currently at 2,100, so it's almost in the buy zone. So advertising did get hit last year, but it's starting to come back. I think it's a precursor. They're seeing that the economy is going to open up, and I think it's going to do well. And plus, if one of their moonshots hit, like Waymo, and people actually start really one of those moonshots hits, it's going to roll. Thank you.
All right. Thanks, Steve. I think DHI is one of the rare exceptions where Yankee, our club, bought it and it's actually gone up in price, which has been great. And I regret not getting in on my personal accounts while it was still in the buy range.
Yeah, it looks very, very strong. It really does. Very strong right now.
Okay, Ira.
Okay, Gentex, I have as a whole. It's at 35. I have a buy up to 24. The Q4 earnings was 58 cents a share, a 48% rise year over year, and they beat estimates of 50 cents. The Q4 revenue was 521.6 million from their automotive section, which is their largest automotive product section. That's their largest section, and that beat the 470 million estimate. The overall revenue was 529.9, and that beat the 481 million estimate as well. So they're pretty strong, but they're in the whole range. Regeneron, I actually have a buy. It's at 485. I have a buy up to 520. They had a great quarter. Their cholesterol drug, Preluent, led their earnings beat. Their sales in that drug was up 24%, and they recently had a successful judgment for that drug. It was I think another company was contesting their use of that drug or something. Anyway, they had a ruling in their favor on that drug. Their earnings were $9.53 a share, which beat the $8.38 estimate. Their earnings were up 27%. Sales were 2.42 billion, and that was up 30%. That's what I have.
Okay, thank you. Jack.
Okay. I've got Dollar General, Sprout Farmers Market, and Essent all reporting in the next month or so. Essent reports next week. Sprouts reports the week after, and Dollar General reports the second week of March. So we did get a new value line for both Dollar General and Sprouts, although the SSG didn't change very much because of that. So the Dollar General is still in the hold zone, Sprouts is in the buy zone, and Essent is in the buy zone. And I didn't see much news out about any of these guys. So there'll be a lot happening next month.
Okay, we'll stand by for that. Liz?
Okay, so we've got Alta and Middleby. So not much to report on Middleby. They filed an SEC Schedule 13G, EdgePoint Investment Group. I guess they issued stock to EdgePoint. I'm not exactly sure what that means. That might be a topic for my next educational segment. They are in the hold zone. They're actually down a little bit from our meeting last month. They're at 134.38. So they're in the hold zone. Alta also filed a number of the 13Gs. They've got, let's see, Vanguard, Alliance, Bernstein, and BlackRock issued shares to them. And I think it was like a penny a share. Their big news is they have a planned investment of more than 25 million to launch a diversity and inclusion program. So they've hired Tracy Ellis Ross, who is Diana Ross's daughter. Tracy Ellis Ross is also the CEO and founder of her own beauty company. So what they're going to be doing is they're going to double the number of Black-owned brands that they carry. They're also going to be mandatory in-store training for all of the salon associates, and they're also looking to promote within the company BIPOC people. So they're going to be products, staff, leadership, and partnering with Black-owned brands, which I think is a good move. They are in the hold zone. They closed at 319.88, and they are up from last month. So that's all I have to say about them. Thanks.
Okay, thank you. Yeah, Sriram?
Yes, sir. I am tracking INS and MLR. INS is the Intelligent Systems, which is a financial support company based out of Atlanta. So far, as you recall, when Jack was presenting, this was about 40% on the annualized internal rate of return on this. But on Friday, it dropped by about 12% of its price. Apparently, a couple of days before that, analysts said that, oh, they're not going to make it 40%. They will be, for the next year, projected values only about 22% or so. So I certainly want to keep an eye on this. Again, both of them are in buy range right now for the latest SSGs I did. On the intelligent systems, both of them actually, both companies, INS and Miller Industries, they're having their quarterly calls in early March. I certainly want to listen to those calls and see how the trends are between now and then. And again, nothing major has happened, but we talked about, Steve mentioned about Visa. Again, this is going to benefit from when people are going to spend more money. Hopefully the trend will continue on intelligent systems and see what happens. Right now, I do not recommend any changes on intelligent systems. Any questions or any comments from our members on intelligent systems? Okay, moving on to Miller. Again, Miller seems to be one of the better performers so far, probably the best performers in our portfolio on an annualized rate of return, but they seem to be very well-managed business, and they are anticipating increase in their sales as we proceed due to, again, the economy continue to improve. They also have their scheduled quarterly call early March. Again, they are still in our buy range. I certainly don't have much to add to this company at this point.
Okay, thank you. In the agenda, I still had Jack assigned to the watch list, but Sriram, are you inheriting that?
Yes.
They haven't switched yet, but yeah, if Sriram has done it, then let him go.
Yeah. I will take over.
Okay, anything to present on Five Below or Viva this month?
I don't have anything, Jack. Brent.
Yeah, it's they're both in the sell range, but they're also both expiring. Essentially, the Viva was added last February, and Five Below, I think, was added more than a year ago. So it's time to reevaluate whether we still want them on our watch list or not. Or if we want them, then somebody has to do a new SSG.
Right. Or that could be their whatever their monthly presentation is to redo those.
Yeah.
Okay, I don't mind dropping these off the watch list. Does anyone have any concerns with that?
I think Ira did Five Below, and
I think
Steve did Viva.
Yeah, I think Five Below has been on our watch list for I don't even have a date. I forgot to put it.
Yeah.
It's been on
No,
quite a
I
while.
don't remember. It was a while ago.
Yeah, 4 or 5 months probably.
Okay, well, hearing no objections, I'll on next month's agenda I'll drop Five Below and Viva, and then I guess if folks are looking for potential companies to present, you can dip into that if they are back in the buy range. Okay, great. Thanks everyone. So now we come to the voting portion. I'll open up the floor to any proposals. I don't think I heard really any major sell candidates. So I was going to propose that we buy First Savings, but it's with a paltry, $1,300. So it would represent, 0.5% of the portfolio. And I know Steve has concerns, I believe, in investing in it.
I think that's a good idea. Let's just spend our money and buy FSFG.
Okay, any yay or nay from other members?
Yeah, I second that. There's no reason that we can't dollar cost average into it per month if what's presented isn't better than that. So
Yeah, I agree. I support that, and we'll get about 20 or 21 shares for this $1,300 at about, I think, $60. So yeah, I think it'll be a good starting point, and we can add as we need.
Okay, Liz or Ira, any objections?
No, I'd go with that.
Yeah, I'm okay with it. Just let's be aware of how many companies we're tracking versus how many people we have here. So when you get up to 3 per person, you're pushing it anyway.
Agreed. We have a little bit of room to grow in that. But yes, point well taken.
I've got just a question. Sriram, did you say MLR was in the buy zone? Or was it INS?
Yeah, let me check real quick. Bear with me for 1 second. INS is in buy zone. MLR is in just above the buy zone.
Okay. Because as an alternative, I would have said put the money into MLR because it seems to be doing well. But if it's not in the buy zone, then I would go with FSG. FSFG.
Yeah, I agree. No, it's just outside of the buy zone.
Okay,
Okay,
so I'll
Sean.
buy, I'll spend the cash and buy FSFG on Tuesday, I guess, because Monday's a holiday. I think.
Right.
I forget what it is.
And I guess this brings up a good point. We touched on the fractional shares before. I guess that would also allow you us to spend all the way down to like spend all $1,324. But we prefer, and correct me if I'm wrong, we prefer keeping it whole share values just for cleanliness sake.
Yes, I think that's right. I did that by accident, and it would be worthwhile to remember that if we want to buy an expensive stock, like add to Google, say, or get a position in some really expensive stock like Tesla.
Right.
We don't have to have all the money to buy a share. We can buy half a share.
Okay.
So Brent,
yeah.
to your point,
Yeah, go ahead.
to your point, do you want to clean up DR Horton and make it with 4 zeros after the decimal point then? Because there's no cost to trade, right? So you could clean that up if you want to keep everything with 4 zeros after the decimal point.
Yeah, I'd be okay with that. I think it's like selling off what, like $15 worth or so.
Yeah, I'll see if I can do that. I think I can.
Okay.
So you're saying to sell a fractional of DR Horton?
Yeah, sell
Right,
Yeah.
just so it's in
0.278.
line with everything else.
Oh,
Yeah, it's less than a third of a share. It's 0.278 or something.
Yeah, 0.278, and it'll be about $18.49 when we sell
If they'll let you do it.
it.
Right.
I think I will.
Yeah. Or alternatively, we can, if we are so particular about making 4 zeros, we can add that remaining fraction and make it into a full.
Yeah,
yeah.
that would cause me some arithmetic pain, though.
Yeah, you got to get it right to the penny.
Yeah. No, I mean, I don't know. I'm perfectly fine both ways.
My thought is if it's doing well, I would keep the fractional share.
It'll
Yeah,
remind us that we can buy fractional shares if we feel like it.
I'm deferring to the treasurer just because he has to deal with these numbers, and I appreciate that he does, so I don't have to. So if it's cleaning it up is well worth it, I think it's worth the $16 or something that we lose out. We
Okay.
just harvest our gains early, I think.
Yeah.
Okay. Any other buy or sell proposals? Okay. Sounds good. Moving on then. On the agenda I have for old business, the remaining open items from the financial audit, we'll kick that to the end after we end the recording, and people can drop off if they're not interested. Skipping to new business, Vivio, and I'll pull back the presenter right so people can see the agenda. For new business, Vivio account renewal. Jack, I think you had seen the email from Vivio. Just wanted to touch base on, have you reached out to them to renew our account?
Yes, I sent a note to Vivio and got a nice reply saying we are now renewed until 2022.
Perfect.
So we're
Okay,
all set.
great. Thank you. And then also related tax form status. How is that coming?
So I checked Friday, and they hadn't released the tax forms yet. From that, the tax software from Vivio isn't done yet, so they have to wait until IRS releases the rules, which is sometime in January, and then it takes them a couple of weeks to get it done. So it's not there yet, but they said in mid-February it'll be there. So that's next week. So I have all the information necessary to do this. I have the 1099s and the capital gains information from both Ameritrade and Fidelity here at my desk. So I can fill out the tax forms as soon as BVL gives them to me.
Okay. And
So
I
next month, and as soon as that happens, you guys will get your K1s. So that should happen in the next week or two.
okay. Has anyone heard of that are they pushing out the tax due date like they did last year, or is it back to normal?
No, I don't think so.
Okay,
It's back to the old style.
gotcha.
Yeah, it's due April 15th.
No, March.
Yeah, the club
Well,
tax return is due March 15th, but
Right.
the individual is still April 15th.
April
Right.
15th, gotcha. Yep, okay. Just was curious.
Yep.
Okay, thanks, Jack, for that status update. Just wanted to highlight if Sharon Watkins is joining us. I got her email regarding her packed schedule with work and other things. So she was slated to present in March. At her request, we've pushed her out to later in the year, June. So hopefully things with work and everything can calm down a little bit. And I've pulled the roster of our regular members forward. I think for May, I had left you off the list, Sriram, but I'm going to put you in for May on that. So Steve is going next month for a stock study in March, and then Sriram, I have you for educational segment.
Absolutely.
And
On the
then go ahead.
segment, can I recommend, is there a reason we don't do a PERT report for our portfolio?
I don't think anyone has volunteered to do one. That's the only reason.
What was the question?
PERT report, portfolio evaluation review technique.
Oh,
If it's okay with you all, I will try to present it next month. And based on that, maybe we can see that is something we want to use to keep track of our investments.
You're planning on doing that for the educational segment? I think that would
Yeah.
work well.
Yeah.
Okay.
Yeah,
Sounds
and if it works, we can use it. Does it sound like a plan?
Sure.
Yes.
Works for
Definitely.
me.
Yeah, Shivram, what SSGs would you use for that? The ones we have on file or ones you have?
I recreated all of them on my and set up a portfolio within the Better Investing account. I will try doing both. I will try from the current as well as from the original ones and see where they stand. I think it makes sense to do it from the original SSGs, I believe. I know Joe is an expert on it. Joe, what do you say?
I don't know if I qualify as an expert, but my model club and both of my face-to-face clubs use the PERT on a monthly basis. What we try to do is use the original until it has been updated to every 6 months. You go in or so, you go in and look at a stock and you do a new SSG, whatever your procedure is, and then we update to that new one and do the PERT based on it. The only thing we allow to change, we don't change any of our decisions that we made as far as growth and PE ratios are concerned. But we do allow the change on a quarterly basis as we do the update of the software. It picks up a new quarter's worth of sales and earnings per share and use that as part of a semi-update, if you will, and until we do an official review of the stock and change our growth prospects or our PE prospects.
Okay. I will check to see, make sure that we have the original ones and try to recreate it. And if I can do that, that'll be the one we will try to track.
Okay, sounds good. Thanks.
Good.
Okay, and just wanted to touch on at the end of the agenda here, the handouts, we list the next couple of months meeting dates on there just for planning purposes.
I would have everyone note that I added 3 other things to the handouts today during the meeting, things that were requested. If anybody needs those things, they're in the handouts for download.
Okay, thank you, Joe. All right, and I'll jump back to thanking everyone for attending this month. It was a great discussion. Next month, we're meeting March 13th, 11 a.m. Eastern. Like we discussed earlier, if you've registered with Better Investing, you should get automatic emails, I think a week ahead of time, an hour ahead of time, with the login information. If not, the link on your screen is where you can go to register for it. Just go to betterinvesting.org, search for online events, and it should take you to it. And then once again, if you have questions or if you're interested in joining, reach out to Sriram at the email address shown, and he'd be happy to answer any questions or give the new member application process for any interested people. Okay, thanks everyone. We're going to continue on with the rest of the financial audit. We can stop the recording and hope to see you again next month.